Welcome to Stress-Free Investing Analysis, Personal Notes. I'll just give you a quick second to read the mandatory CB disclaimer on your screen right now before we move forward. Okay, ready? Let's get to the good stuff. Okay, let's dive into this. Today, we're going to use a rigorous 5-step scorecard approach to really unmask data patterns and see if its sky-high valuation actually holds up. We'll be looking at their unrivaled defense moat, their financial fortress, a massive 307-day risk factor, valuation and runways, and finally, our exact entry strategy. Starting with Section 1, the unrivaled defense moat. Let's see how this entirely debt-free company maintains a monopoly-like grip on its sector. Seriously, what makes this company so compelling right out of the gate is what I call the only factors. They are literally the only vertically integrated defense electronics firm in India. That means they build everything in-house, from designing the bare silicon to full system integration. Plus, they are the only ones supplying electronics across all major Indian defense platforms. It's 100% domestically manufactured. And get this, they just successfully flight tested an indigenous BrahMos missile seeker. That is a huge breakthrough. For any competitor trying to replicate this impenetrable technology moat, you're talking at least a decade of hard work and easily over 1,000 crore rupees. It's just not happening anytime soon. And this brilliantly illustrates exactly how perfectly diversified their revenue is across high-growth, mission-critical military sectors. You've got radar systems making up over 31%, avionics at nearly 29%, and electronic warfare sitting at almost 27%. These are highly sensitive, super complex domains with very few competitors. They aren't just reliant on a single piece of hardware, they are deeply, deeply embedded across the entire defense ecosystem. Moving on to Section 2. Financial fortress and growth. This is where it gets crazy, because this hardware manufacturing company actually earns software-like margins. Boom, look at that number, 36%. That is their core EBITDA margin for the first 9 months of fiscal year 26. Pulling a 36% margin in hardware manufacturing is an absolute anomaly. It is a massive quality signal, and it's driven almost entirely by their vertical integration and that proprietary intellectual property we just talked about. They simply don't have to pay massive vendor markups.
Let's move to and see how this builds into an absolute fortress of a balance sheet. They are sitting on a very comfortable 327 crore rupees in net cash with absolute zero debt. So you've got a high-margin business carrying zero financial leverage risk.
Looking at the numbers over the last few years, the consistency is just striking. Check out that stellar 31.4% revenue compound annual growth rate over the last 3 years. And look right here at the 9MFY26 column. Revenue absolutely spiked by 86% year over year. Profits after tax are compounding beautifully too. On a trailing basis, this financial engine is firing on all cylinders. But let's shift the tone for Section 3, the 307-day elephant. Because honestly, no company is completely perfect. Let's address the cash flow. Exactly. But wait, what about the cash flow? Seriously, with amazing profits and zero debt, you might think this is a totally flawless operation. But if you look under the hood at fiscal year 25, data patterns reported a deeply negative free cash flow, meaning cash actually leaving the business, to the tune of minus 312 crore rupees. Why on earth would a profitable, debt-free company be burning cash like that? So the crucial point is right here. 307 days. That is their massive receivable cycle. Basically, a huge chunk of their revenue gets tied up as working capital because they have to wait almost an entire year to get paid after delivering their products. This is fundamentally the single biggest red flag in their financial profile. However, we have to look at the reality behind this delay. Yes, on one side, this creates significant working capital stress. But on the other side, look at who actually owes them this money. It's government entities like Bell and ECIL. That means there is absolute zero default risk here. The money is solid. And thankfully, that 327 crore cash fortress we talked about, it easily absorbs this delay. It's really just a structural feature of defense contracting. Let's go to Section 4, valuation and future runways. We need to see if this world-class business is currently priced entirely out of reach for regular investors. All right, here is your reality check. 93 times. The stock is trading at a trailing price-to-earnings ratio of 93x. That is an objectively steep premium. The market is demanding a very high price for this level of quality, so it's not cheap. The real question is whether their future growth can actually justify this multiple.
Let's break down the scenarios. In our base case, the current price is completely fair, but only if management continues to execute their 20 to 30% growth guidance absolutely flawlessly. If growth slows down to our bear case of around 10 to 15%, the stock could definitely correct sharply down to around 2,800 rupees. But look at that bull case. If they land those big export orders and ramp up the LCA MK2, we could see a target price of 6,500 rupees.
And honestly, what supports that 93x PE? Massive, undeniable tailwinds. They have a wildly clear 3 to 5 year visibility runway. Just look at their order book. It's sitting at over 2,156 crore rupees. That's roughly 3 times their trailing revenue. Add to that the Atmanirbhar Para indigenization policies, surging defense exports, and the huge potential of putting their indigenous seeker into exported BrahMos missiles. The growth runway is just exceptional.
Which brings us to Section 5, the final verdict and entry strategy. I promise, we're going to tie all this rigorous analysis into a final, actionable framework right now.
Now, what's really interesting about this slide is the final output of our quantitative model. It gives data patterns a stress-free score of 82 out of 100. That earns the stock a solid A- grade.
And here's exactly how that score breaks down. They snagged an incredible 18 out of 20 for financial health, 13 for their competitive moat, and an exceptional 14 for the growth runway. The only things weighing down this practically perfect score are the valuation, which gets an 8 because that high PE limits our margin of safety, and a slight deduction for that 307-day receivable cycle we dissected earlier.
So what is the actual entry strategy? While this is undoubtedly a core holding quality business, patience is absolutely key here. The current market price is hovering right around its all-time high. The ideal move is to not chase it, but to accumulate heavily during 15 to 20% market corrections. You really want to look for that ideal entry zone between 3,400 and 3,800 rupees to build a comfortable margin of safety.
Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay up to date with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next video. Thank you for watching, and keep your investing stress-free investing.